There, it's me, Stephen Thomas, with yet another housing debrief. First, I want to dive right in and talk about what is going on with the housing market right now today. This is the middle of April. May 16th is when we're recording this. So what's going on is we've absorbed these higher rates for the month of April, and we hit 7.5% 3 different times in the month of April. And as a result, spring wasn't as robust as it could be, but demand is very, very similar. And what we term as demand, our pending sales activity, very, very similar to 2023, which was kind of like this bottom that we were rolling on. But with these higher rates, and we have more homeowners participating, that are coming on the market, we actually have a rise in the inventory. And demand is kind of been rising a little bit from week to week. And as a result, when you have inventory going up a little bit faster than demand, the market slowed a little bit. It's not enough if you're in the trenches to see a difference of like 1 or 2 days longer to sell a home, but we can see it in the trend lines, and it's pretty much has a lot to do with what's going on with mortgage rates right now and where they're at, which leads us right to where are we at today? Let's talk about the housing market helped by falling rates, because rates have come down considerably. And we're going to talk about where we are right now today, and if this continues, where things are headed and how these rates will help housing. First, I wanted to talk about Daddy Warbucks sitting on the side. There's a lot of investors sitting on a lot of cash out there, and they're sitting on a lot of cash. They're waiting to pounce on either the stock market that goes down or long-term issuance of debt if things slow down in the U.S. economy. A couple of those areas are 10-year treasuries and mortgage-backed securities. There's this love affair that goes back and forth between the treasury, the investor looking at treasury bonds and mortgage-backed securities, so they kind of like jive the same. And you could see this going all the way back to 1972, and I'm only going to show you going back to 2015 with this chart, that the average spread between the blue line, that's 10-year treasuries, and the red line, that's where 30-year mortgage rates are for the day. And as a result, the average spread going all the way back, and this is actually Freddie Mac's interest rate survey that they've done for a very, very long time, Freddie Mac's mortgage-backed survey. So the spread is 1.71. And that's that yellow bar right there in the middle that shows you the difference between the red and the blue line. That's 1.71. Now on the right-hand side, that's where we are today. The spread is a lot larger than it should be. And the reason for it is all the uncertainty. So everybody, lenders, banks, servicers, anybody tied to actually making money off of these loans, they want to charge a little bit more for all the uncertainty that's out there, because what they're fearful of is that the U.S. economy slows, and then as a result, the Federal Reserve cuts rates, and then all of a sudden everybody wants to refinance. So what they've done is they've padded everything so they can make money right away, because down the road they understand that that's exactly what's going to happen. And you could kind of see that we already had a massive refinance spike that happened when we went from 8% interest rates in October to 6.5% interest rates by the end of December. That was such a big change that we had people that had closed their transactions and were already refinancing less than 2 months later. So that just shows you exactly why there's this extra spread, because they want to make sure that they make money off of the loans that they're putting together today. So that's that average spread. So when will this go back towards normal? When there's less uncertainty out there and the Fed is not orchestrating where everything should be, and they're back to more of a normal, what they call a neutral rate. So the Federal Reserve, this is the Federal Reserve, this is Jerome Powell and all the minion presidents. They've got together, and beginning August of 2022, they said they're going to inflict pain on all consumers out there, and as well as all businesses, that they needed to do that in order to get inflation under control. And what they've said over and over again is they are very, very data dependent. So as a result, everybody in economics land and also financial land has been very, very data dependent as well. And when you're very, very data dependent, you're looking to the data. And April was not very favorable for the data. And what I mean by that is, you know what? The United States economy was way too hot for its britches in April. They were coming out with everything for the prior month. So they were looking at March, everything from March. And that's what April showed those data points. So As a result, one of the big data points, we can talk about jobs. Jobs was big, but consumer price index is what struck a lot of fear in so many different investors that are out there. And I say investors because there aren't that many economists that really track this stuff that are extremely fearful of these CPI numbers. Because CPI, it wasn't a big change. You can see those three purple. It says last 12 months. That was the last 12 months. Those purple dots is what is core CPI. CPI is just a basket of goods, but they strip out the volatility of food and fuel because the Fed can't do anything with that. And you see the three purple dots on the right-hand side, that's January, February, March. And from February to March, it actually rose a little bit. And as a result of it rising, a lot of people flipped out. And when it rose, we saw that the 10-year Treasury rose, and so did interest rates that day. I'm pointing to that very day when CPI came out. Everybody freaked out, and we watched interest rates just balloon higher. And then later on in the month of April, we got U.S. retail sales. And retail sales, again, came in way too hot, way above expectations. And I'm pointing to for the month of March. And as a result, I'm showing you the higher red line is pointing to what happened when the retail sales came out. All of a sudden, it spiked higher, 10-year Treasury and interest rates that day. And then later on in the month, we got GDP. GDP was supposed to come in at 2.5, but instead was at 1.6%. Actually, it showed that the first quarter that the economy was a little bit slower than what everybody had thought. Now, everybody jumped to a new conclusion called stagflation, and that's where inflation's going out of control, which it's not. And we have a slowing economy. 1.6% is not a really slow economy. It's slower than it was last year, but we couldn't continue the pace that we did last year because it requires the consumers to be spending at quite a clip. And remember, last year there was still quite a bit of stimulus savings money that U.S. consumers were exhausting like crazy. They were spending like crazy. Well, once that's gone, they're not going to be spending it at that same pace, right? So the 10-year Treasury, as a result, I'm showing you the highest red line arrow, and that's showing you where that was the absorption of this stagflation, GDP coming down a little bit, and the more negativity that's out there. Because you know what? Crazy traders and investors are a little bit nutty. And as a result, they're sitting there, they're crazy, they're nuts, and what they do is they overreact to every single data point, and April was just a series of data points for them all to go a little bit nuts and go ahead and overreact. And the Fed was supposed to cut rates 3 times this year, and as a result, this isn't the Fed saying anything, these are traders and Wall Street saying, no longer are we talking about 3, we're talking about 2, and some then we're talking about 1, and even some knuckleheads, yes, knuckleheads out there, we're talking about no rate cuts, and even other knuckleheads were talking about 1 rate hike, that they need to hike rates, which is absolutely ridiculous because if you look at everything, there's too restrictive and there's a lot of other headwinds that we're all watching in economics land that we're not going to get into. But which just goes to show you that a lot of times the doomer and gloomers win and everybody goes negative really quick and they think that it's going to be just like 2023 and we're going to have rates that continue to rise higher and higher and we'll be at 8% in no time. But then along came May. And May was a totally different story, a different flavor in the all the myriad of flavors that are out there. And you could actually see it in job openings. Job openings were released that first week of May, and that was a couple of weeks ago. And job openings had dropped all the way down to 8.5 million, which it was all the way up at 9 million just a couple months ago. It's coming down. And as soon as that gets below 8 million into the sevens, that's where the Fed kind of really wants to be. So it's actually moving in the right direction. This beat expectations. It was lower than expectations. And then also the April jobs report. It came in at 175,000. It was supposed to be a lot higher than that, but it was less. So jobs are finally slowing a little bit, which they don't want to have too many job openings and not enough job seekers. As a result, that puts too much pressure on salaries and which puts pressure on prices, which puts pressure on inflation. That's why they want to see that the job market comes into a better balance. And unemployment actually went up a little bit. These just show that things are slowing down from the too hot for britches that we had for the year 2023. And then the Fed met that same week, and actually they talked about what? They talked about, this is the first week, they were a lot more dovish, more conciliatory, saying that, yeah, we can still see that we're going to be doing rate cuts. We're not talking anything about rate hikes or anything like that, you knuckleheads on Wall Street. And we don't have stagflation. We don't have stag. We don't have inflation. And the little economics joke that he made in the middle of his press conference, the Q&A section. And as a result, what happened in the 10-year Treasury? Now I'm showing you the green line. That was that first week. You see that big giant drop? That was all the absorption of jobs in the Fed meeting. We came down a lot in the 10-year Treasury and mortgage rates. So that was the first big push down. Then CPI came out yesterday. And when we looked at CPI, holy cow, CPI was a lot less than what everybody was thinking out there. It was very, very close to expectations. It wasn't beating expectations like last month. And if you look at those purple dots, look at this. You see that the January to February to March. The last one is April. April's actually down, and it's down quite a bit. So there you go. It's down. It's not down huge, but it is going in the right direction. And we're not exceeding expectations, and we don't see inflation rising. We see core CPI actually dropping from 3.8 to 3.6%. So yes, it's coming down. And this isn't even the best inflation gauge that's out there. PCE is personal consumption expenditure, and that actually is the more accurate of the two, but this one is the sexy one that everybody follows. But PCE comes later in the month. That's the one that the Fed actually pays more attention to because they have a much better shelter component. The shelter component in CPI is actually broken, and it's a little bit wacky. They need to update it. They haven't. So until they do that, the PCE is going to be the more accurate one of the two. But nonetheless, CPI came in where it came down, and then we on that same day, we got retail sales, and retail sales came in flat. This was lower than expectations. And then February and March were actually revised down. So we had revisions down, and it was flat from month to month, from March to April. So this wasn't as big of a print as what they were thinking. And then as a result, you can see what's going on with interest rates. They came down even further, quite a bit of a change in such a period of time. So now those rate cuts that everybody were talking about, a lot of them were saying, this is not happening until September. Some were saying November. Some were saying only one in December. And then we're hearing after the election, November and December are the two. But now we're hearing more and more people, it's getting louder and louder that it's going to happen in September, which means that things can change on a dime based upon what's happening in the data. That's why we follow the data. And there are even some people, if the data continues to go the direction it goes, the Fed could make a move as early as June. And this is actually what we feel needs to happen at Reports on Housing, looking at everything, that the longer they wait, the more damage that they're going to cause to the economy, which means that the housing market will be great down the road, but it will be more damage for some other areas of the economy. And that's not really what we want to see if you're trying to orchestrate that soft landing. So you can actually see this in interest rates at 6.99%. So for the first time in a really long time, we have rates that have actually come down to under 7%. Yeah, I know 6.99 is pretty much 7%, but still, there's something psychological about having an interest rate that starts in the sixes. And that's what we are getting right now today. So this is a huge win for buyers, because now it makes things a lot more affordable. And you can actually see this in, if you want $3,000 per month with 20% down, just principal and interest, at 7.5% just a few weeks ago, you're looking at a $536,000 house. Well, now that they're at 7%, you're looking at a $563,000 house. And you could see as rates fall further, which later on the year we have, there's a pathway to get to 6%. You're looking at a $626,000 house. So you see what's happening is it's opening up a more affordable environment, which will encourage more buyers to get into the marketplace. And also, as rates come down, more homeowners that are enjoying their low rates. With rates coming down, finally, it'll encourage some to go, yeah, you know what? I want to get in now. I'm tired of waiting. I wanted to move for a long time, and now rates aren't as excessively high. They're coming down. So what will happen is, first, demand will skyrocket. And then down the road, we'll get more homeowners that come on. But the demand the increase in demand will outpace the increase in homeowners that are coming on the market. So we are already seeing more homeowners this year, which is a great sign, which means that there are more opportunities, more choices for buyers that are out there. And I want to encourage everybody to go to reportsonhousing.com, because now we have reports that dot all over SoCal, the Bay Area. We're now in Maricopa County, Phoenix, and Clark County, Las Vegas. So we are growing and we're expanding and we're all over the place. And our most recent report that just came out is called More Choices. And that's because there are more choices finally this year. There are more homes coming on the market than last year. There are more sellers, more signs in the yards, which is good. It means a slight thawing of the housing market. So if you liked this, I encourage you to like and subscribe to our channel. And also, if you'd like to go to Reports on Housing and you want one of our reports, utilize the coupon code DROPPING for a free month. So just wanted to say thank you for tuning in. Thank you for watching these housing debriefs. We're all about bringing you the latest and greatest housing news so that you can make really good, mature, solid decisions based upon proper expectations, not doomer and gloomer websites or YouTube videos or anything like that. We're not here for scare tactics. I'm not here for rah-rah, because what I do think is down the road, we're going to get rates that come down enough where when we have more demand, but we do have more homes coming in the market, but demand outpacing the number of homes coming on the market, we'll get prices that continue to rise. And when prices continue to rise at a more unfavorable clip, we believe that is unhealthy for housing, but that we're trying to paint the expectations of the way it's going to be once these rates drop, so that you can make the proper decisions for your families or yourself right now, today, based upon the good data that's out there. This is not a narrative. This is nothing we're cheering on. This is just something so that you can make good decisions out there. So thank you for tuning in. I hope you have a fantastic finish this week, and we will see you on the other